Thank you for joining me this Friday, the 24th of February. I'm Grady, market analyst with Bell Direct. This is the weekly market update. As we near the tail end of reporting season, key themes and investor reactions have continued throughout the third week of reporting, especially in the wake of some big names releasing results. So far, we have seen 192 companies report, of which 62 have beaten expectations, 71 have come in line with expectations, and 59 have fallen short of expectations. The investor reactions have again been centred around dividend adjustments, future outlooks, and the way companies have managed costs in the first half of FY23. Let's dive into the key results of this week. You may have noticed your weekly food shop at Woolworths or Coles has increased over the last few months. That is because both supermarket giants have ended their respective price freezes on over 200 trolley items that was imposed when interest rates began rising last year. This is a bad thing for our hip pockets, but a good thing for investors, as both companies offset rising costs by increasing the prices of their products. For the half, Woolworths operating cash flow rose 24%, Big W EBIT rose 437%, sales rose 4% to $33.17 billion, and NPAT was up 14% to $907 million. The supermarket giant also declared a near 18% rise in the interim dividend to 46 cents per share. Coles reported NPAT up 17.1% to $643 million. Sales revenue from continuing operations rose 9.9% to $20.8 billion, and the company declared a 9.1% increase in the interim dividend to 36 cents per share. It's safe to say both supermarket giants are faring pretty well in the current post-pandemic environment. Big miners also released this week, and we are seeing an increasing focus on shifting out of coal and into greener operations as nations and investors around the world move to prioritise ESG. Santos, BHP, Whitehaven Coal are just some of the names moving toward clean, green energy and away from coal. Mining giant BHP Group headlined the reporting season results this week from releasing on Thursday with a 32% drop in first half profit to $6.46 billion, which actually exceeded consensus expectations of $5.975 billion. The company's total revenue fell 24% to $25.7 billion, and BHP declared a 90 US cents per share interim dividend, which is a decline of 40% on the prior corresponding period. The catalyst of the sharply lower results is blamed on wet weather, rising costs, and China's COVID-19 restrictions throughout the first half. BHP CEO Mike Henry said the company is positive about demand outlook for H2 and into FY24. The company also announced it is selling 2 more Queensland coal mines, the Daunia and Blackwater coking coal operations, to focus the company's portfolio on the highest quality metallurgical coal assets. Rio Tinto also fell out of favour with investors this week after reporting a trimmed interim dividend amid a decline in the price of iron ore. While Santos rallied on the day its results were released after the company increased its full-year dividend by 78% to 15.1 US cents per share. And the flying kangaroo has delivered on its expectation to turn a profit for the first half of FY23 by announcing a record half-year profit of $1.43 billion, attributed to a dramatic turnaround in travel demand post-pandemic, offsetting fuel costs increasing. The group's capacity also returned to 72% of pre-COVID levels, with domestic at 94% and international at 60% of pre-COVID levels. Net debt levels also came in below the target range of $2.4 billion, and Qantas announced an on-market share buyback of up to $500 million. Qantas did, however, increase its CAPEX guidance range to rephase its existing fleet and provided no quantitative guidance for the remainder of FY23. Locally, from Monday to Thursday, the ASX fell 0.84% amid a global market sell-off on the back of the RBA and US Federal Reserve releasing cash rate meeting minutes, which both respectively shared outlooks on the need to continue raising interest rates over the coming months as inflation remains stubbornly high. Consumer discretionary and real estate stocks took big hits this week as investors generally flee such sectors as rising interest rates curb consumer spending challenging and don't bode well for real estate companies carrying high levels of debt. The winning stocks from Monday to Thursday were led by Eager Automotive, jumping 16.18% on FY22 results, including a record dividend, while Ingham's added 15.33% and Origin Energy rallied 14.3% for the 4 days. On the losing end, Domino's Pizza tumbled over 22.52% after slashing its dividend amid profit sliding for the first half. Taking a look at the All Ords, New Century Resources soared over 32% after receiving an off-market takeover offer, while Clearview Wealth rallied 20.43% and ServiceStream added 17.5% over the last 4 days. Cogstate took the biggest hit on the All Ords this week, tumbling almost 30% after being issued a price query by the ASX during the week. The most traded stocks by Bell Direct clients from Monday to Thursday were BHP, AMP, Fortescue Metals Group and Bellevue Gold. Clients also bought into Pilbara Minerals, Commonwealth Bank of Australia and Sayona Mining, while taking profits from Woodside Energy, Rio Tinto and Macquarie Group. On the ETF front, we saw the most trading in iShares Core S&P ASX 200 ETF, BetaShares Active Australian Hybrids Fund ETF and BetaShares Geared US Equity Fund ETF. On the economic data front next week, local investors will be anticipating the release of Australia's GDP growth rate for the fourth quarter out on Wednesday to determine how effective the RBA's rate hikes have been in slowing economic growth to date. And that's all we have time for today. Have a wonderful Friday and as always, happy investing.